You second guess yourself and your entire portfolio. You're considering just selling it all off and investing in a Vanguard fund. People on Twitter are posting their gains back and forth, call options are printing, and you're stuck eating your 4th packet of ramen noodles for the day. Sound familiar? Well, guess what? You're bad at investing. Hey guys, it's Nima. I'm back with another Z Investor video. As always, make sure to like and subscribe. It really helps with the algorithm and us pushing out good quality content. Anyways, on to the video. We're getting into 3 different reasons why you're bad at investing. These 3 main reasons are emotional trading, daily fluctuations, and timing the market, and finally, not having faith in your analysis and picks. Please note that we actually don't think you're bad at investing. Everyone has their own journey and their own mistakes that they go through, and learn from these mistakes. The numbers that you see in your portfolio don't really mean anything in the grand scheme of things. On top of that, this video is not financial advice. It's just a collection of mistakes that we see beginners make and us trying to provide educational info about them. The first reason of why you're bad at investing is emotional trading. Emotional trading refers to how your behavior is dictating your trades and investments rather than your actual analysis and research. If you're always concerned about daily price movements in a stock or a business's day chart, then you're gonna build an emotional attachment to your gains and losses. Emotional trading is like blurting the first thing you think of in a conversation. That's not really how you want a conversation to go usually. And the same would go for your money. And don't get me wrong, it's easy to get caught up in stock prices every single day and what's going on in the media and news when there's so much screaming at you every single day. And it's also really easy to feel like the entire world is just crumbling around you and the next grand recession is just a couple minutes away. To me, at least, it's really interesting how humans lose rationality when they most need it. So how do you prevent emotional trading and not keep up with the motley fool every single day? Mr. Market is irrational, moody, and will offer you the chance to buy low and sell high. And he's there to serve you. You are not there to serve Mr. Market. You don't have to fall for him when he's all sad and saying the entire market's gonna collapse, or rush buying when he's all happy and saying the market is going exponential. Don't be anybody's pawn. You are to take advantage of Mr. Market. Wait until Mr. Market is in a pessimistic mood and offers you the chance to buy low. Patience is key when dealing with Mr. Market, and it's the key when markets fluctuate with your emotions. This is where the philosophy of buy and hold comes from. The easy part is buying and finding a good stock. The hard part is patience. Patience is what differs good investors from great investors. One of the things I've learned over the years, and something one of my biggest idols have told me, is that the sooner you realize it takes time to become rich, the sooner it will happen. On to the second reason that's holding you back from being a great investor: daily market fluctuations and timing markets. This video and this channel and all the content we put out here is about investing and not trading. Don't get the two mixed up. The stocks that you pick in your portfolio should be ones that you believe have good fundamentals and will experience growth throughout the years and long term. You shouldn't pick stocks based on their price fluctuations and how much they go up and down in a week or in a day. In our interview with Maj Soydan, he explains that the first thing he does when he looks into businesses is completely cover the price chart and just look at 10K filings, SEC filings, and all the documents and resources he needs to analyze business fundamentals. When you think like this, it's much easier to filter out all the weird price action going on and focus on the core fundamentals of business. Fundamentals always win. In regards to timing markets, Buffett put it perfectly. The stock market will experience swings, but in good times and bad, Buffett stays focused on his goals. And so should all investors. This esteemed investor rarely changes his long-term investing strategy no matter what the market does. It's important that you stick to your analysis, especially with long-term investments. Lastly, we want to talk about doubting yourself. It is very, very, very hard to stay confident about your picks in the market, especially when you have so many seeking alpha bull posts or seeking alpha bear posts, or so many people on Twitter with opposing opinions, or just the media in general. It's very hard to stay dedicated to what you think is a good investment, especially when the price of the stock you buy doesn't really reflect the analysis you've done on it. Here's a short and simple story that everyone can relate to. You do your analysis on a company. It passes every single one of your checklist goals of what a company should have, low PE, growing income, whatever, and you decide to buy the stock. As soon as that happens, the the price goes red on open and you immediately doubt yourself in your research. But realize this, you could have bought something as safe as S&P 500 index fund or bonds, and this would have happened as well. Let me let you guys in on a secret. Okay? Finding good companies in the stock market isn't hard. It's all a test of patience. You know what? If I could sum this entire video up, it'd just be patient. Finding good stocks is really easy, especially when they've experienced a bunch of growth over time, or they're experiencing a bunch of growth in the short term and there are a lot of promises. The hard part though is holding until the company reaches its full potential. Trust your research and your picks. Investing in what you know and understanding price movements will make you a better investor and even increase your emotional intelligence. Don't be in a hurry to make money, because you'll lose it faster than you think. And hey, if your research was genuinely not good and it didn't turn out your end, that's totally fine. You can learn and move on to something else and apply those mistakes you've made to make them your strengths. There you go. You see how much easier it is when you're not stressing over a single bump in a price chart? If you want to avoid panic selling, buying into hype, or losing money in general, then avoid these 3 main mistakes: emotional trading, daily fluctuations in timing markets, and not being confident in your picks. We hope that this video helped you guys out. Hopefully it eased you down a bit and you're a bit more confident in yourself and your investing abilities. It's a hard world out there and it can be really stressful. And hopefully we ease that a bit down, going back to the basics to remind you you're doing just fine. Thanks for watching, guys, and take care.